Welcome to an introduction to economics, brought to you by Parkbench Tutors and narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com. This is the first podcast in a series on balance of payments and foreign exchange, and aims to provide you with an introduction to these topics. What do we mean by a balance in payments? Each time that we buy an electronic gadget that is made in China or a piece of clothing made in Vietnam, we are purchasing an article made overseas. For that to take place, there has to be an exchange between pounds and the currency of the country the article comes from. The same thing applies to any goods we export. So a balance of payments represents the set of accounts showing all the economic transactions taking place between the residents of the United Kingdom and the residents of all the other countries during an accounting period, which is usually a period of 1 year. The balance of payments account is divided into two accounts, a current account and a capital account. The current account is often talked about in terms of visible and invisible trade. The visible trade is simply those exports or imports that have physical characteristics. They represent goods rather than services or transfers. The invisible trade includes services such as insurance and banking, but also flows due to tourism and any transfer of funds from migrants. An outflow, an import, is recorded as a debit. An inflow, that's an export, is recorded as a credit. When we export a good or service, there is an inflow of money from another country as payment. If total imports are greater than total exports, then there is a balance of payments deficit. If total exports are greater than total imports, there is a balance of payments surplus. The capital account includes short and long-term movement that relates to investment. Direct investment takes place when an entity invests directly in an enterprise in a country overseas. Portfolio investments are the purchasing of securities in overseas companies or governments. The account is balanced by official financing, which covers the overall deficit or surplus. If there is a deficit, then the net change is a depletion in the reserves. A surplus gives a build-up of reserves. When debits exceeds credits, there is a deficit, and when credits exceed debits, there is a surplus. Let us have a look then at some recent performance. The map shows that during the period from 2004 to 2007 there has been a trend for a balance of payments deficit, and this deficit was increasing. Note that the figures are reported quarterly. These figures refer only to the current account, so we are looking at trade largely in terms of goods and services and are not considering investments. We can see that the trend up until the mid-1980s was that the account was close to being balanced. A dip then occurs, showing a small deficit, but from 2000 onwards there has been a sharp trend towards an increasing balance of payments deficit, more marked in goods than services. But the trend is for both goods and services to be in deficit. This is the same information but presented as figures. You can see that from the top the picture is presented over the last 3 years. Then there is a breakdown by quarters for 2 years. Finally, a month-by-month breakdown. The figures suggest that the gap may be narrowing in 2011. A persistent imbalance does have implications for the economy. A country with a persistent deficit is losing reserves or is accumulating greater debt with monetary authorities overseas. A surplus also has consequences, since accumulation of reserves boosts domestic money supply and may increase inflationary pressure. Where there is deficit, there is pressure on the exchange rate. Can governments do anything about this? A contracting fiscal policy reduces demand for imports when there is a deficit, whilst an expansionary policy increases demand if there were a surplus. However, these policies would also affect internal objectives, such as control of the rate of unemployment. Deficit-reducing policies are likely to lead to an increase in unemployment. Import controls were used in the past and still are in some areas. However, trade agreements and a desire to promote free trade makes it difficult to apply these controls. There is also a risk of retaliation if goods from a country are subject to import controls by way of duties or other tariffs. The method that usually occurs is by allowing the currency to fluctuate, which means that it can be allowed to depreciate or appreciate against other countries. In the case of a deficit, it would be allowed to depreciate. Before considering effects of allowing currency to fluctuate, we should look at what we mean by exchange rates. The rate of exchange is the rate at which one currency can be exchanged for another. It is the price of one currency in terms of another. There are two rates of exchange in common use. For most of us, the rate of exchange is the current rate, the rate today, and is called the spot rate. When you exchange pounds for dollars or euros for your holiday, you will find the amount can vary according to where you go to make the exchange. What you receive is the tourist rate, which is based on the spot rate. For many businesses, the important rate is the forward rate, which is an agreed rate of exchange for a date in the future, which is usually 90 days. This is useful since the contract for a sale or purchase is made, but the payments will not take place at the same time. Several other activities are associated with exchange rates. Hedging is the action of an importer to take by forward buying to counter any adverse changes in exchange rates. Hedging is an agreement with a bank for a forward rate. Speculation is when someone buys at the forward rate and, if the currency strengthens, sells at that time. So, for an initial exchange rate of £1 to $2, a speculator buys £1,000 using $2,000 at a forward rate. If, after 90 days, the exchange rate is changed to £1 gives $2.4, then the £1,000 can be sold for $2,400, giving a profit of $400. Interest arbitrage may occur if interest rates in two countries differ significantly, and it is considered worthwhile to transfer funds to gain a higher interest rate. There is a risk involved here, since it relies on a correct prediction of the forward exchange rate as well. The map shows the exchange rate of the pound against the euro. Between 2000 and 2002, the rate was above 1.5 euros to the pound. By 2011, it was less than 1.2, having fallen near to parity at one point. This shows that exchange rates can vary considerably, even when currencies are considered to be stable. To consider the effects of rate of exchange, we refer to some of the ideas we have already looked at earlier. Equilibrium is determined by demand and supply, and these in turn are determined by the actions of traders, speculators, and interest arbiters. We will assume trade between two countries, dollar and pound, and consider only the activities of imports and exports. The US needs pounds to buy UK exports. The UK needs dollars to buy US imports. At point A, the demand for pounds is represented by P0, Q0. Suppose that the currency depreciates. Less dollars are needed to buy each pound. The US exports are now cheaper, and this will lead to increased demand. The demand curve shifts right from DD to D'. The demand for pounds increases to P0Q1. The demand curve for pounds slopes down from left to right. Here is that demand shown in map form. The change from a rate of £1 to $2 going to £1 for $1.50, representing depreciation of the pound. As you can see, the downward slope is from left to right. How does a depreciation in currency affect imports? The effect of a currency that has depreciated, the rate moving from P2 to P1, is to decrease the demand for imports from Q2 to Q1. This is because imported goods will be more expensive to importers, and this increase is passed on to consumers. What happens to the supply of pounds following depreciation? Is P1Q1 greater or less than P2Q2 in terms of pounds? This depends on the elasticity of demand for imports. If the demand is elastic, the quantity of imports falls by a bigger proportion than the price rises, so total value of imports and total value of pound falls. The supply curve for pounds slopes up from left to right. If the demand is inelastic, then the quantity of imports falls by a smaller proportion than the price increases, so the total supply of pounds rises. The equilibrium point for the exchange rate is when the demand for pounds is equal to the supply of pounds. This is point R1 on the map. At R3 the supply of pounds exceeds demand, and so the exchange rate is pushed back to R1. At R2 demand exceeds supply, and so the exchange rate is pushed up. The situation represents stable equilibrium. Now, what happens when both curves are downwards from left to right and the supply curve is less steep than the demand curve? The point R4 represents the equilibrium point. At R5 and R6 the competitive forces push the exchange rate further from equilibrium, and the position is unstable. Now we consider the effect of the exchange rate on the economy. We shall use the two country assumptions for our analysis. If the dollar price of UK exports falls from depreciation of the currency, the pound price of US imports rises. There is a rise in demand for exports and a fall in demand for imports. The price effects of depreciation should be easy to follow. The trade balance is equal to total value of exports less total value of imports. And if exports are greater than imports, then there should be a move from a deficit to a surplus. The larger the elasticity of demand for exports, the greater should be the total value of the exports following depreciation. Consider the elasticity of demand here. If the elasticity is less than 1, depreciation raises the value of imports. If elasticity is greater than 1, depreciation reduces the total value of imports. Now, Vx is the elasticity of demand for exports. Then, from equilibrium, if Ex plus Em is greater than 1, trade balance improves. This is called the Marshall-Lerner condition. The absorption approach considers the income effects of depreciation. An increase in exports will increase the national income, and this, in turn, will increase demand for imports. At equilibrium, we found earlier that injections equals withdrawals, when J equals W. Then, I plus X equals S plus M, or X minus M equals S minus I. So, at equilibrium, the planned value of exports less imports should be equal to the planned value of savings less investments. Suppose the initial position is at 0 YE. There is a small trade deficit equal to AC. Currency depreciation should shift X minus M, the planned value of exports less imports, to X minus M dash. The new equilibrium, YE dash, has raised national income. This should also help to reduce unemployment at the same time as eliminating the trade deficit. Suppose, however, that the country is already at full employment. When the shift to X minus M dash occurs, then the new equilibrium should be YE dash. An inflationary gap, BC, has appeared. This is demand inflation, and price rises will then start to make UK exports less competitive. Depreciation effects can include redistribution as profits are increased at the expense of wages, and if the marginal propensity to consume of profit earners is less than that of wage earners, then domestic expenditure will fall. Higher prices of imports will also lead to reduced spending. even if the average income is also rising. This is called the money illusion effect. It is possible that with rising prices and a constant money stock, that spending will be reduced and savings increased. The monetarist approach to depreciation and trade deficit is as follows. At equilibrium, the balance of payments is equal to the total demand for money and the quantity of money created domestically. L, the demand for money, equals M, the supply of money, equals the sum of D, domestically created money, and the change in the reserves. From this, the change in the reserves is the difference between the demand for money and the domestically created money. This ends our first podcast on balance of payments and exchange rates, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For further information about Parkbench Tutors, please visit parkbenchtutors.com.